Hello, everyone. Hope you guys are doing really well today. We are going to be diving into beyond rankings and traffic, the new metrics to measure for digital marketing success. The reason this topic is important is a lot of people are panicking over the last year and even year and a half, sometimes even two, and they're just like, my traffic's declining. My rankings aren't as high as they used to be. I'm screwed. What do I do? And you know what? Even with rankings and traffic going down, let's be honest, no one wants that. But even with those two going down, we're consistently have been able to grow companies' revenue, which is the most important metric. And to grow its revenue or your revenue, you need to look at beyond rankings and traffic because there's other metrics that will define your success. And as marketers, you need to shift what you're looking at so that way you can optimize for more revenue. There's no reason you can't grow in today's world still. So I'm Neil Patel. I'm the co-founder of NP Digital. I also have with me Nikki Lamb and Basil. Nikki, do you want to give a quick introduction of yourself? And then Basil, you can go next.
Yeah, hi everyone. I'm Nikki Lamb, our head of earned media here at NP Digital US. I'm primarily focused on our enterprise business, but I've worked with dozens and dozens of small businesses as well. I'm really excited for today's topic because whether you're a small business or a large enterprise, like Neil said, this is a very timely topic for a lot of our clients and prospects right now.
And hi, everyone. My name is Basil Hatu, and I lead product for us at NP Digital here in Canada for both enterprise and small business. I'm also looking forward to talking and diving into this very complex, but also very interesting and timely topic about measurement and attribution.
When you look at NP Digital, we work with a lot of big brands, but at the same time, we work with tons of SMB brands as well. If you go to the npdigital.com website and you go to our case studies section, you'll see tons of case studies, and majority of them are SMBs, of course, because they make up the majority of the businesses out there in the world. And of course, we also have a lot of case studies with enterprise brands. But the reason I bring this to your attention is if you look at the case studies, you'll see tons of growth. And these are recent case studies. You're seeing tons of growth in today's market with all the shifts of Google and AI overviews and people losing traffic. Yet companies are able to grow. Now, it doesn't mean that you're only going to grow if you work with us. Don't get me wrong, that would be nice. But it's more so how you think about marketing, what you're measuring today, and what you're focusing your efforts on so that way you can have success. Because if you're focusing your efforts on the old metrics like rankings and traffic, what you'll find is you're optimizing for something that doesn't matter as much anymore. Yes, SEO is still valuable, GEO is still valuable, but there's other metrics that you need to look at and optimize for. And when you do that, that's when you'll start seeing growth because you're focusing your marketing efforts on the right things instead of the wrong things. Now, if you just want us to fix the metrics that are driving the wrong decisions for you and help you focus on the right metrics and come up with a game plan and actually execute on it for you, you can just take your phone, scan that QR code. It'll take you to npdigital.com, fill out your information, and we'll get in touch with you. We work in 28 plus countries. So no matter where you are, what size you are, we should have people who can help. Or worst case, you can just go to npdigital.com and fill out your information. Now, before we dive in to the new playbook and how you need to adapt, keep in mind the playbook of, oh, we need more traffic. Well, traffic is getting less meaningful. People are using multiple channels. They're doing the research on these LLMs before they even visit your website. So you may get less traffic, but the traffic that you are getting should be converting at a higher rate. Attribution is also trickier than it's ever been. The reason being is someone may end up discovering your brand on social media. Then they end up researching your company and products on Reddit. Then they ask LLMs if it'll work for their business type or their personal type based on their circumstances. Then they go to your website and buy, right? That's an example of one journey, and that can all happen within, call it 10, 20, 30 minutes. And currently in marketing, what we're seeing, and we've been seeing this for a long time, if you look at all C-level roles within organizations, the CMO has the shortest tenure. In other words, they tend to get fired more quickly. And one of the biggest reasons, executives want proof of impact. Marketing spends a lot of money. It doesn't matter if you're SMB or a large enterprise. It's a big percentage of the budget. People want to know, hey, did this actually drive results? And we're going to be talking about things like incrementality and MMM and a few other things like that, which are super important. With incrementality, think of it this way. If you're running ads or a campaign and a segment saw that campaign and another segment didn't see the campaign, what was actually the true lift, right? When you think about MMM, media mix modeling, think of you have all this data, historical data. It's all aggregated. You're slicing and dicing it and analyzing it so you can figure out what worked for you in the past and what didn't work for you. So that way, before you run new campaigns, you can figure out what's going to be effective, what's not, what's probably going to be a waste of money. So then that way you're being much smarter with your money.
All right, so let's jump in and start to define what this measurement reset really means. So Neil said it a couple times in his introduction, right? Traffic is really starting to become more of a vanity metric, which I get it. It's crazy. We've all been focused on rankings and traffic for so long. But it's important to share with you all that our NPD studies and our client data are both showing that for many brands, like Neil said, even though traffic is declining, revenue and conversions either aren't declining at all or they're declining at a much, much lower rate when you're focused on the right metrics. And let's not forget, more sessions has never always meant more buying intent, right? A lot of us have been focused on, very top of funnel things, or sometimes even gotten a little bit far away from what our website or our brand truly represents. So that traffic hasn't always been super valuable for you anyway. So we really want to start to measure engagement quality and down funnel impact, because session counts, we know that those can be off or, inflated for a lot of different reasons. If you're in the SEO community specifically, you know that we saw this last year when we found out that impressions were very inflated in Google Search Console just due to software scraping the SERP to try to report on rankings. So, that was never valuable for your website anyway. And so we really want to try to take a step back and remember that, like Neil said, right, today, people are engaging across a lot of platforms before they might ever click on your website. That could be video content on a platform like YouTube or TikTok. That could be Google's AI overviews, other AI answers. The Google search results page is also now flooded with a ton of different SERP features. We've got people also ask and what people are saying, which is highlighting social content right within Google search results page. So, there's all these various ways that people are engaging with a brand. And this just means that the landscape has really fractured. Not everybody goes directly to Google to ingest information anymore. So your real goal should be to garner more influence and more profitable outcomes. And this really requires better visibility into what's shaping demand upstream. So with that said, this is NPD's outcomes first measurement stack. So most marketing teams historically have been looking at a traditional funnel. That traditional funnel starts with traffic, rankings, click-through rates, right? But this outcomes first measurement stack starts with business outcomes at the top: revenue, lifetime value, retention, profit, the metrics that really truly matter. The metrics that, as Neil said, right, this is what the C-suite and boards are looking for. So this shift really reframes marketing as a profit driver instead of just an activity center, right? You can get all the traffic in the world and it might never convert. So at the top here, those are really the most important business outcomes that you have to be focused on in today's day and age. And you'll see below that, you'll find those demand signals. These demand signals are really just proof that your influence is working, right? Your influence is helping more people convert. And then at the bottom, that's where you see those early indicator metrics like visibility and influence. And those are really the foundation instead of where things start. So this right here is the measurement reset. So metrics like, everything we've just talked about, right? Traffic, rankings, click-through rate, the metrics that you might have been overly focused on in the past, these are what we would call diagnostic metrics, right? They help explain why something has changed, but they never have guaranteed critical business outcomes like revenue. So they're really helpful to understand your performance, but if you overly focus on them, or if you look at them in isolation, they can be super misleading. In fact, our data shows that these metrics are becoming less critical in today's day and age, whereas metrics like mentions, if you look on the chart, mentions, citations, sentiment, these things are actually growing in importance right now. Okay, and let's talk about something really essential: messaging consistency. So there used to be this well-known rule called the rule of 7, which essentially meant that customers needed to encounter your brand somewhere around 7 times before they might remember you and actually take action. I think today, I think we have a slide on this in a few slides. It's more like 12 today. It could be many more depending on your sector or your business. But regardless, when your value proposition appears very consistently across multiple channels, brand recall improves and conversion quality actually increases. And the reverse we've also found is true. If you've got inconsistent messaging and you're not showing up consistently when people encounter you, like I said earlier, right, in a video on YouTube or TikTok or on a social platform, if it's inconsistent messaging, that's going to weaken your influence, even if your visibility is strong. So now that our community generally is in agreement that things like rankings and traffic are starting to become a little bit more, leading indicators or vanity metrics, not the end all be all, it's important to discuss what metrics you should be looking at instead, right? And these are metrics that we are talking to our clients about all the time right now. These are things like your share of search or your share of voice against competitors, right? Your competitors might be growing at a faster rate than you're growing, and that's important to note. Things like branded demand growth, right? How many people are actively searching for your brand, and how is that changing over time? Similarly, if your competitors are growing their branded search demand at a much higher rate than you, if you're stagnant or flat, or if your branded demand is even declining, which we've certainly seen over the years, that also impacts your ability to capture that influence. So other things like incremental lift, I know Neil talked about that already, category level visibility, these are all really helpful metrics to look at today because they show whether or not you're actually expanding your influence within your market. And in 2026, we don't think of SEO as just search engine optimization anymore. We're really leaning into this concept called search everywhere optimization because, like I've mentioned, right, search is fracturing. Neil talked about this. People are engaging across lots of different surfaces, and prospective buyers are evaluating you across all of these different platforms, right? It could still be Google, and we know that Google still has, a lot of success, but it's also places like YouTube, LinkedIn, review platforms, forums like Reddit and Quora, and of course, all of the AI engines that are now, a really hot topic. So this really means that you have to grow your presence across more surfaces than ever before. You have to do search everywhere optimization. And more importantly, your measurement strategy has to account for how the brand appears across these surfaces. You can't just rely on rankings and website visits. Now, a couple slides ago, I talked about the importance of monitoring your branded search demand, especially in comparison to competitors. So this is essential today because your brand demand, from what we've seen, can really predict your future revenue and the velocity of that revenue. Rising branded search, direct traffic, the amount of returning users, these all signal a growing preference for your brand and likely a growing pipeline. So these metrics are helpful to show momentum even before your conversions might actually spike. And this is something that we can't talk about enough today. Credibility and brand trust are everything in this AI era. In fact, our data shows that more reviews and more positive reviews correlate to more traffic. So, also focus on things like getting mentions in trusted publications, having expert citations, strong reviews, like I said, and real community engagement, because these are all really influencing buying decisions. And today, like we've said, being found and being visible, it's not enough. You actually have to be preferred. You have to be chosen. And finally, another important metrics that I've mentioned in this presentation is share of voice, because this really reflects your competitive influence. So share of voice shows how visible you are relative to your competitors, right? Not just in isolation. And this is an important distinction because, like I said earlier, you can be growing your traffic, but you can still lose ground if your competitors are growing faster than you. And we know that buying decisions today are very comparative. If your brand appears more often during the research and consideration phases, then your influence is, really taking shape before that demand converts.
So basically, all this might seem like marketing measurement has become incredibly sophisticated, but actually what's happening is the landscape is shifting. And that focus is shifting to simply tightening that connection between marketing metrics and business reality. And that's the North Star framework that we're going to be sharing with you. So, and to understand that framework, we must take a step back and acknowledge what business leaders actually focus on. And that's profit quality over raw revenue, predictable growth over random or these periodic spikes, and retention over one-time wins. The thing is, marketing is always the strongest when its metrics clearly support those outcomes. Everything else, clicks, impressions, even ROAS, should be interpreted in service of those outcomes. And that shift alone changes how we evaluate performance for paid and for organic. That also means pivoting away from simple dashboards that can sometimes serve more of it like a disconnect between the stakeholder goals and the marketing outputs. See, most modern dashboards were built for optimization. They're excellent at showing engagements, they're great at showing efficiency, even channel level performance. But optimization can sometimes become separated from the economics. So it's no surprise that even though 92% of marketers prioritize profit, a lot of the dashboards are still built for a world where there's 10 blue links, and then are faced with the reality where you can improve click-through rates, but your margins weaken. You can grow your lead volume while payback stretches, and you can increase ROAS while customer lifetime value shrinks. So step by step, we need to evolve from tracking activity metrics. Those are like your clicks, your rankings. Even if none of those metrics are wrong, they just need context. And that context, in our view, is business impact. And an effective way that we see marketers, even our teams, can begin to broaden that context is to shift to these demand signals, not just engagement signals. Think of it this way. In SEO, clicks show interaction. That's an engagement signal. But when a user delegates their assembly work to an AI, that signal erodes. And a shift onto demand signals becomes more important. Those demand signals show us whether our effort are actually influencing the buyer journey, whether they're building brand. And that means tracking and monitoring brand preferences, which can be crucial to understand whether we're building trust. Begins to track conversion lead and visitor quality, which reveals whether we're passing and vetting the process and passing the vetting process that consumers have and effectively answering the questions they asked. And velocity signals, which show whether we're effective at ensuring that users land at the right and appropriate page and receiving the information they expected. When those move together, it suggests something new. It suggests that marketing is strengthening the entire ecosystem, not just winning inside one platform. So brand preferences, qualified pipelines, conversion quality, those become more important. And you'll see this later in the slides. Elevating those discussions help you broaden your testing framework, because when you're too fixated on KPIs that are like cost per clicks, it makes incrementality testing very hard. for marketers. And that's why we spend so much time analyzing and studying these new demand signals as we do changing mindsets with executives and marketing teams and broader stakeholders. We do that to avoid the metrics trap. These traps are when, for example, marketers continuously optimize click-through rates, but the interfaces are changing, like with OpenAI and Claude. It's when we overweigh ROAS without considering marginal or lifetime value. See, ROAS is funny because it hides marginal curves. Your first $1,000 is not as efficient as your second $1,000 that you spend. Averages hide these margins.
Basil, do you want to quickly break down marginal curves so people can understand it a little bit better?
Yeah, absolutely. It's
and sorry to interrupt. Basil's extremely smart. So is Nikki. I've pitched a lot with Basil for a lot of different companies all over the world. Basil's really great at pitching, super technical, and he has a lot of amazing insights. But we're gonna break it down in a digestible format so that way, you know, SMBs and everyone can understand.
I think the simple way to think of marginal curve is when you spend your first $1,000, you're going to have a certain cost per new customer acquisition. But your second $1,000 is going to likely be less efficient. And the third 3,000 is going to be even less efficient. That's the incrementality, because every business will always have a certain baseline. So that's the marginal curve. Is we'll always expect a certain amount of revenue, leads, it'd be checkouts on our e-com website. But as we reach a certain level, that becomes flattens. So your spend to get that next user becomes more expensive, which, by the way, can be very daunting, but it's a very simple concept. I'm happy to, obviously, at the end, if you guys have more questions, to get into it. But for those in earned and SEO, these traps manifest when they don't factor in these new elements. So think semantic density, chunk retrievals. This is what we do in the SEO. So we might drive the users to our, we might drive the click, but we're losing the citations, and these metrics can be gamed. And if they can be gamed, they will be gamed. And this is why open lead quality, revenue, more demos, more checkouts, more people in our stores, those metrics are hard to fake. They are tied to our business goals and cash flow. In all this shift, I know that sometimes the hardest thing to measure is trust. So, but in this new era, especially with AI, trust has become the new conversion currency. If a brand gets cited, it attracts high intent users who are already deep in their decision session. So we're moving from this idea of volume, getting as many eyeballs as possible, to value, getting our brand recommended to the right user. And we as marketers have to pay very close attention to that inflection point. And just like lead growth, on its own, it can really hide declining business health, because we've all been in this situation. You can lead and drive growth while your payback stretches, or your retention weakens, or your deal size shrinks. The dashboards still look green, but the business quietly erodes. And that's why conversion quality matters more than front-end volume. That's what customers value. And now, because of technology, we can measure these downstream aspects more closely. So if we want to, so as we do that, by measuring the effectiveness of each channel and what happens after that sale, we can start to understand the relationships between the different channels. I'll give a very simple example. When we think of downstream, paid media always gets more credit than traditional organic SEO, and that's always been the case. But earned media doesn't operate in that same model as money in and money out ecosystem. Earned media and SEO, they build trust moats, proprietary data with deep expertise and content that AI can't easily hallucinate with or replicate. That's why SEO is crucial and why some channels get more attention than others, for some, like paid. But the moat here ensures that when you build that credibility and drive a user who trusts you before they click, they're pre-sold. That means not just a better cost per lead, it means a better lead to closing ratio. It means better revenue per lead. It means better downstream margins and better retention contribution. That's why front-end efficiency without downstream can sometimes be misleading, and we always emphasize the need of looking long-term into the impact of a click. Velocity is also a great indicator of quality. I almost feel like velocity is an economic lever that is always undermeasured. The thing is, for most consumers, time, and we might not realize that, time is money, literally, for them as well. And speed matters. And some journeys, like those with AI right now, compress that journey. And if the time to close shrinks, CAC, or cost per acquiring a customer, improves, even if it leads to volume and even if it stays flat, that's incrementality. And when that happens, it means the users are moving faster from the question of what is this to what should I do? And these faster sales cycle mean for a lot of marketers, less working capital is tied up, faster payback on their marketing budget, and much better cash flow for the business. So marketers should be able to measure consumer value by seeing better lead to value and better retention rates. Value can also be measured through margin-adjusted CAC, or customer cost per acquiring a customer. See, just simple CAC, it only makes sense once margin and retention are factored in. The truth is, on paper, low cost per customer acquisition looks like a win. But in a decision session economy, retention is much, much harder. And knowing whether spending $1,000 to acquire a customer or $100 to acquire a customer is either brilliant or reckless, well, that really depends on what's the margin, what's the retention curve, what's the expansion potential. So adjusted CAC forces us to ask, are we acquiring customers who value our expertise? Those are high margin type of customers. Or are we acquiring customers who just value our price? Those are low margin customers. That's why we say raw CAC without context is a vanity metric. And marketing doesn't stop at the checkout. See, lifetime value tells us what customers value overall, and payback tells us how long you will have to wait to see that value. And together, they determine whether marketing is a growth engine or a cash drain for most businesses, especially when platforms like Google are pushing for personal AI that knows your history, that knows your context. If we aren't delivering value post the sale, the user's personal AI will likely recommend a competitor next time. So lifetime value is the ultimate measure of whether we are building a brand or just buying transactions. So it becomes more important to factor that in. Long payback and with churn will collapse your business. This is where marketing moves from cost center to what we like to call the capital allocator. Now, this is really interesting as well, and curious what the viewers as well on this webinar think. Retention is part of the answer layer. And marketing's job, our job, unfortunately or fortunately, depending on whose side you're on, doesn't end at the acquisition. In B2B, for example, and in subscription models, marketing effort actually sets expectations, shapes onboarding, influences usage, drives expansion. And when your existing customers have a problem, do they ask you or do they ask ChatGPT? And if they ask ChatGPT and you aren't cited, marketing can't really say that's not ours. You lose the expansion opportunity. So retention has become also part of marketing's true contribution to ROI. And that's where all the roads lead back. With good performance and strong reporting, you can start to really measure ROAS as a business. We have to stop reporting on this idea of marketing island and start reporting on the business mainland. High ROAS on low margin is a good trap for that. High traffic on zero-click queries is a good trap for that. So our recommendation is always to avoid those and be able to bring new context into the equation. To do that, we have to also recognize that attribution can sometimes be misleading. See, attribution marketing over credits the last click. It loves to give credit to that last touch, whatever channel that is, the thing that captures demand. It usually ignores the work that created the demand. It undercredits that creation. And in the AI world, this probably gets even worse. So a user might see your brand on ChatGPT or Claude, get a recommendation in Perplexity, and then type your URL directly. Attribution will say direct traffic. Reality says AI. We can't rely on attribution alone to tell us what's working. Does that mean performance failed? Not necessarily. It just means the interface has changed, and we need metrics that reflect that reality. And that makes performance look cleaner than it actually is. And that's where assisted conversions and view-through rate metrics are really useful context for marketing teams. These signals are useful for color, not just causation. But used alone, they can be misleading. And we need to use them to understand the journey, not just to justify wasted ad spend or marketing spend. So for example, since we can't fully track all the AI citations and prompts in GA4, we need diagnostic math to fill the gap. And this is simple. We just use proxies like shared visibility rate that Nikki shared, how often we appear in AI answers compared to our traditional top 10 ranking. These signals provide that context that usually attribution lacks or doesn't give. So remember, assisted and view-through metrics should be used carefully to explain patterns and add colors to the journey, but never claim the absolute causation here. They must be read alongside incrementality and revenue outcomes to support decisions rather than justify wasted ad spend. Context determines that meaning. And with the North Star set, the question pivots to, well, how do we get there? And how do we answer that question of, did marketing cause growth, or did it just capture demand that already existed? What's the truth? Well, the answer is incrementality. It's the gold standard traditionally. It's what we do a lot with our clients at NPD because it answers whether we actually generate new revenue, or did we just pay for customers that were already buying. That helps us really build that context.
On a side note, I was in one of the largest retailers in the world, and I was in their offices a month and a half ago, 2 months ago, and they ran this experiment with this AI channel, and they spent a lot. It didn't drive the sales they were looking for, and they're like, well, this is not bad. We can make it work. We can scale it up. And the first thing I told them is, have you actually checked how many net new customers you're getting? So they're spending all this money. They checked. No joke. Less than 3% of the customers they got were net new. So they're already marketing to those customers and generating revenue from. It's just more so this new campaign that they ran started taking quote unquote credit for the sales with them. And I was just like, yes, I'm like, you probably would have had a large chunk of those sales if you never spent the money in the first place. And when they started looking at the campaign from that aspect, they're just like, wait, this is actually very unprofitable. And then they stopped doing it, and they didn't notice a decrease in sales other than roughly, 4 or 5%. So it wasn't 100% perfect with the tracking, but it quickly showed that, it wasn't driving that many sales. And this is when they were specifically looking at digital from this specific channel, not total sales, right? So.
Yeah, like Neil, it goes back to the question that executives are asking of marketing teams. They're not asking click-through rate. They're asking incrementality. Did marketing cause growth, or did it just capture that demand that already exists? And
yes,
in simple terms, they're asking, if we stop spending, what would happen? If we turn marketing spend off, does the result drop off? And if we scale, does it grow? That's really incrementality testing. Everything else is correlation. This distinction determines budget allocation. It helps us determine what channels are worth scaling and whether marketing is seen as a cost center or a growth engine. And I think even more so today in AI, capture is harder because AI is actually capturing the user and incrementality can play a very crucial, like an important role in creating and identifying channels that generate demand, and really more so than others. So very important context as well. And as marketings tackle incrementality, we must remember, by the way, that probably no single method solves everything. And to survive the measurement collapse, as I like to call it today, of the old guard and the pivot to measurement catalyst, you need an outcome-first measurement stack. Incrementality testing delivers the highest probably confidence and is prioritized by 90% from what you see here in our chart and our study. 90% of all marketers prioritize incrementality testing to really identify true causal lift. But we can't just use that alone. We must also combine this with attribution modeling for day-to-day journey insights and the notion of marketing mix modeling, which is a strategic budget allocation. And we think a sophisticated team would layer each of these, I'm going to call them imperfect methods on their own, but together they triangulate the truth. Incrementality testing for the true lift, attribution for day-to-day tactical optimization, and MMM or media mix modeling for strategic budget allocation. So when should we use incrementality? Well, it's an easier answer probably than most people would determine. The best way to understand incrementality is to launch a new channel. That's always been the case. But incrementality helps us answer the hard questions. It doesn't help us understand if we turn off our spend, does revenue drop? It's meant to answer what is the incremental ROI of a specific channel. So use incrementality testing when you need undeniable proof. It helps us prove whether a campaign is creating new conversions and whether it's actually driving new revenue. So should we scale this channel? That's a question for incrementality testing. Is this campaign creating new conversions? That's a question for incrementality testing. And should we shift budget onto another one? That's an incrementality. You need controlled experiments, geo holdouts, lift studies. It creates proof, not just correlation. That's a good cause for incrementality testing for most marketers. And we use MMM not to answer the questions I outlined in the previous, which channels engage last, but rather which channels drove results over time. See, media mix modeling, it's simple Bayesian statistical modeling. It's critical when you want to understand what channels drove results over a long period of time. And you need a lot of data traditionally for that, but usually a year of all your historical sales and media data. Because brand authority, for example, doesn't just materialize instantly, it does take time. So MMM helps account for lagged effect and diminishing returns. And this is a great model for understanding ROI when your journey is fragmented, when you have a mix of online and offline revenue potential, like retail, when your business has a lagged effect, such as in B2B, where the people are exposed to your ads, but might convert in next month or a few weeks out. And you're trying to understand the diminishing curve of your media budget. So it doesn't give the overall perfect truth, but it does help you reveal at what point does investing in this channel become incremental or not. And lastly, even though attribution modeling still has a place, it's primarily for directional insights. Use it to fill the gaps where direct measurement is not possible, to understand patterns across large or fragmented journeys, and to identify measurement issues with any specific channel. So it's useful when you're trying to do specific channel diagnostics, you're trying to understand pattern detection for certain investments, and you're trying to figure out where the gaps lie in the user journey. So use attribution when you need speed, but it's not a strategic layer in most instances. It's great for filling the gaps where MMM and incrementality is not really answering those questions. But we like to always recommend, never treat it as an absolute gospel in your measurement outline. So to simplify everything, I know I've shared a lot, and I'm happy to answer any questions at the end here. There's three. It comes down to three things: marginal return curves, incremental revenue. That's the actual lift. Incremental lift, cost per incremental acquisition. That's the real cost. Payback period. That's the speed to returning your investment. These three work together proves the impact, not just the activity of you. And I'll leave you guys with this. These new measurement guidelines are sometimes can be very complicated, but just a doctrine. And over the next few months and years, the businesses that win in this space, they basically have to do a couple of things: map the terrain honestly, understand their ecosystem, adjust the doctrine to match the reality of their business, build casual truth outside of the platform, not just in the platform. Use MMM as a strategic foundation for your marketing, which is very easy to do, and trust internal evidence over platform narrative.
On a side note, speaking about payback period, we have an interesting chart that comes out, I think, in the next week or so, because I've been scheduling the charts in advance. And when we looked at a handful of businesses, more than a handful, it was quite a few, but less than 100. When you look at how much they're spending on marketing campaigns over the last 3 years, their cost per campaign has been going up, which is obvious because marketing is getting more and more expensive, especially with ads and stuff like that. And these are one-off campaigns. But then when you look at their payback period is actually getting shorter. And there's this big notion that marketing is getting more expensive, harder to make a ROI. The concept that marketing is getting more expensive is true. But we're seeing is because a lot of companies are leveraging some of the, this 3 buckets that you talked about, they're able to better allocate their money for future campaigns. And what they're finding is yes, marketing is getting more expensive, but they're dropping the dead weight much faster. So the campaigns are becoming much more profitable and the payback periods are getting shorter and shorter, which is working out even with marketing costs rising. So cool. So let's dive into the action plan for, the next 30 days and beyond. So in week 1, we want to fix what you measure. You got to first by started auditing your reports, right? So what metrics are you targeting or tracking more so? Some of them are going to be vanity metrics. Some of them, will be metrics that impact your bottom line. Some are important, like lifetime value of your customer, and just some are really useless altogether, such as like a lot of people still talk to me about bounce rate. Doesn't matter if your bounce rate's high or low. If you're driving more revenue, great. If you're driving less, that kind of sucks. And you want that revenue to be profitable. Your metrics also need to be profit aware, like I just mentioned, because driving revenue is fine, but if you can't scale in a profitable way, you're just wasting your time. From things like payback period that we are just talking about, or LTV to CAC, these are all metrics that you need to look at on a weekly basis. You also want standardized definitions. This is extremely important because people have different understandings of different metrics. You can use AI to help you come up with standardized rubric, or take all the stuff that you believe in, create a whole glossary or template from it, and then give it to people so then that way everyone's on the same page. And most important, you need clean data hygiene. It really starts here. If your data is out of whack, if it's messy, it's not accurate, the rest doesn't matter. If you can't trust your data, you will not be able to make informed marketing decisions. I remember I had someone work for me a while ago, and this will make sense in a bit. And we were asking him on conversion data and if a test actually drove more sales. This person was in charge of data and analytics, and this was quite a bit ago. And they were just like, this test drastically boosted sales. So I just go into the back end and I'm looking at the raw data, like actual transactions, right? Like processor transactions, like credit card processing. And I'm like, where are you getting more sales from? I look at net new sales. I actually see a little bit of a decline. I'm pretty sure this test is hurting conversions, not helping. And they're showing it to me. And I was like, you aren't looking at data the right way. This was what their job was, and they weren't necessarily the best at, making sure the data was clean and in a way where you can actually make informed decisions. The last thing you want to do as a business, if I went with what this person was recommending, I would have hurt the business and seen around 6% less revenue going forward. That's the importance of data. You have to make sure your data is clean, or else you're going to screw yourself over. Now, the next 30 to 90 days, you can launch an incrementality test on a major channel, build some scoreboards, and more so, you need to also start looking at things from a cohort perspective, right? And the reason I say cohort perspective, I want you to think about your marketing. You have a lot of users. A lot of times your older customers influence what you're seeing, and you're just like, oh, look, we're still doing really well. Look at all this other revenue and upsells, and everything's really good. You make changes and you don't necessarily see how it impacts your business, because it's not necessarily that the data is lost, but it's mixing with a lot of other noise, and that other noise could be really masking the results from your new campaigns. When you look at cohorts, you can be like, okay, we changed this onboarding experience. Does it increase our LTV? Does it reduce our churn? And when you start looking at cohorts, you can compare people who signed up this week versus people who signed up 5 weeks ago, and look at how they interacted the first week, the next week, the first month, the first 2 months, the first 3 months. How long did it come for them to be a repeat purchase, or how long did it take for them to churn? And these changes that you're making will tell you if they're actually having a positive impact. You may not see it in your numbers right away because it's such a small percentage of your total users or revenue. But if you're starting to see positive lifts like this when you're using cohorts, that means later down the road, you should start seeing some massive gains from it, but it just takes time to see. And this is why cohorts are really important. Next 6 to 12 months, right? MMM, unified data, and better incentives. We've talked about quite a bit of this over the last 50-ish minutes. And even if you're starting at a small scale, that's okay. Something is better than nothing. I know it could be really overwhelming to do all of this at once. If you just want my team to do it for you guys can always reach out to us at NP Digital. We have a massive data and analytics team. I know that sounds boring and ugly, but the money is in the boring and ugly. And the new KPIs, I won't bore you with this because I know we're getting closer to the 1 a.m. time. I don't know what time zone you guys are on, but it's 1 a.m. for me almost. And I want to make sure we have good time for Q&A, but I'm not going to read the old metrics, the new metrics, things like visibility, what's your share of voice, what's the sentiment analysis, are people saying more positive things for you versus the competition? What's your brand growth? You can use Google Trends to see, is your brand growing over time or declining? How's that stacking up compared to your competition? You want, check lifts. You want to check not just, hey, how many leads are we getting? What percentage of leads are actually closing, right? What's your margin adjusted CAC and your payback period? How many returning users are you getting? What's the cohort value? Is your LTV over time going up? Is it going down? How's it looking per channel, right? These are all metrics that you need to start looking at. Now, the opportunity is in disruption. It's not in doing what everyone else is doing. It's about doing stuff that's, in many cases, outside of the box. And what the marketing leaders must do differently, you got to treat rankings and traffic as diagnostics, not goals. You got to track influence before revenue really appears, because people go to ChatGPT, they look at places like Reddit and Quora, they look at Wikipedia, they're looking at your reviews and ratings, all before they're going to your website and even buying. They're looking at YouTube videos that other people are creating about your products and services. And you want to make sure that you're adopting a lot of the stuff that we're talking today. You don't have to do it all at once. Step by step is okay. And make sure you have a scorecard that looks at things like visibility, demand, outcomes, and you're reviewing them together. Again, if you just want us to do all this for you, you can bust out your phone, scan that QR code. It'll take you to npdigital.com, fill out your information. We'd love to get in touch with you and help you out with any of your data analytics, or you can just run with it on your own as well, because you have this deck. If you can't find it, it's usually on YouTube or my X profile. All right, Colin, let's get into some Q&A.
Some good stuff. Yes, a replay always goes out after the webinar. You can find it on YouTube. Really, really great stuff. Tons of questions. And I feel like as much as everything has changed, a lot of it is still the same, right? Like we've been talking about attribution and MMMs and all that stuff for a long, long time. And with AI and LLMs, it's just gotten like crazy town. So lots of questions. Let's start with Nikki, and Neil, feel free to jump in. We talked a bit about rankings not being as important. It was actually on one of the previous slides just a moment ago. If rankings aren't as important as they once were, does that mean that search volume isn't really as important either? For years, we've been using search volume to help determine our priorities. Then we would use rankings, impressions, and traffics as primary KPIs. Nikki, thoughts?
Yeah, search volume is still an important metric to look at, but it is losing its weight because we know that people are searching new queries that have never been searched before way more than they used to, because everything's getting super long tail. So I definitely recommend you still take a look at search volume across your primary categories and topics, but you also want to be flexible. You want to be optimizing for super long tail questions that might not have a lot of search volume tied to them, but base those optimizations on understanding your audience. What do people ask when they call in for customer service? What are people typing into the chatbot that you might have on your website? They might not be searching those things on Google, but they're wanting to understand them. So you can use tools like Answer the Public also to find, longer tail searches. And we all know that people are searching things in AI surfaces, right? ChatGPT, Gemini, that are probably not going to show search volume in places like a SEMrush or an Ubersuggest or a keyword planner tool. So just keep an open mind when it comes to optimizing for low or no search volume keywords.
The switch you need to make is start looking at topics. Nikki touched a bit on this, in which you want to make sure your topic has volume, and you want to cover it super thoroughly. Now, to cover it super thoroughly, yes, you want to focus on the long tail because that's how people are starting to search, and that is going to be the shift, and you're going to see that it being the majority. Technically, it already is, but it's going to be even more of the percentage. And when I say you want to optimize for the long tail, that doesn't mean that you need to cover every single long tail keyword. When you cover a topic thoroughly, the LLMs and algorithms are smart enough to figure out that, okay, you, Neil, or NP Digital, or Nikki, or Basil are known for digital marketing. We'll pull from you and we'll start showing your responses for everything related to these subjects.
Good stuff. Basil, over to you. When you move clients away from last click, what's the biggest internal fight? Like convincing the CFO or the paid media team who suddenly loses credit for their conversions? Like what's your experience with clients?
You're muted, Basil.
Mutiny.
I was saying, I love that I got the fighting question. So I don't know if it's a fight. I think it's very important for those in our role to understand the inertia that is causing this friction and why we're not moving. And what we've seen is there's probably four. There's financial inertia, the sunk cost and their dedication to attribution tools. So we spend millions on attribution platforms, so we're not willing to pivot our thinking. We've seen friction around skills. The teams are only trained on one legacy system. So we're now asking them to look at things differently. Well, it's a skill inertia. We noticed and observed governance inertia, like it's broad expectations. And from the team, our stakeholders expect a certain level of reporting. And it could be architecture inertia. Everything else is interconnected. So if we change our measurement, what does that mean? So it's not that it's understanding what is the inertia that is causing the friction and addressing it directly.
Awesome. And while I have you, because there were lots of questions for you. You spoke about marginal curve. I think that is a new concept or topic for a lot of folks. Do you think that applies to SMBs that have much smaller budgets? I think when you were speaking to marginal curve, you were talking about, in the thousands, and we had a viewer ask, like, is that something that you can pick up on when the budget's like in the hundreds, or is this just a bigger budget thing? Can you explain?
Yeah. So the marginal curve applies to any business, regardless of the size. There's always a level where the next dollar is not as effective as the previous one. That's a reality. The question becomes whether we can actually identify it if we're spending smaller. And if you're spending smaller, that means we need more data to identify that marginal curve. So the answer is yes, it is relevant to any business and any size, but maybe identifying it and noticing that noise becomes a bit harder if your spend is smaller. But I don't think spend alone is the only criteria. It's how many channels you're investing on. It's not just also spend. What I like about marginal curves is we look at things that are non-media factors as well. So it could be economic, it could be things like unemployment rate, it could be your GDP rate, it could be a lot of other things on a local level or municipal level that can be used in modeling. But definitely harder to observe, which means when you're spending less, so we just need a bit more data.
Yep, or longer periods of time to collect that data. So Nikki, back over to you, and maybe Neil, you've got some thoughts on this too. Never seen this question before, but a good one. Some food for thought, a user said. Does using a certain AI tool for creating content for your website, not just text, but maybe images and videos, increase the chances of you getting exposure on that particular AI platform? So if you're using ChatGPT to help craft all of your content and your assets, do you think there's maybe a chance of getting greater visibility, organic visibility within those platforms? We can start with you, Nikki.
Unfortunately not. We haven't seen any data or studies showing that there's some sort of favorability in terms of where something has been produced. The signals we know that are driving success for, AI search optimization, GEO, LLMO, whatever you want to call it, are actually strongly correlated to a lot of SEO signals. Not to say that there isn't, a lot of things we're working on beyond just traditional SEO, but we know that with retrieval augmented generation, which is basically these AI tools actually accessing Google's search index, Bing search index, your content being, found and visible on these traditional SEO platforms helps your content be surfaced in AI. And there's a lot of other factors that influence whether or not you're found. I could talk to you for probably hours about that. But on that long list of factors, how you're creating your AI generated content, whether that be text or video or imagery, is not something that we've seen have an increase in your visibility across those AI models.
Awesome. Top of the hour. That's all we've got time for.
Well, thank you very much. If you guys need help with your marketing, check us out at npdigital.com. We really appreciate it. Take care.
Thanks, everyone.
Thanks all.